A very good morning to you all, and thanks for joining. As you will have read, we released an announcement this morning that the company has entered into a sale and purchase agreement with Macquarie to acquire a 25% non-operated participating interest in the producing Mereenie oil and gas fields onshore Australia in the Northern Territory. The acquisition has been executed together with ASX-listed New Zealand Oil and Gas Limited, an incumbent joint venture partner in the Mereenie fields, whom will also acquire a 25% interest from Macquarie on identical terms. So in this morning's presentation, I will take you through a summary of the transaction, the investment proposition, a little background on the asset, and how it fits with the strategy. I will start by pointing you to our compliance statement and disclaimer, which relates to today's presentation, which I would encourage you all to read in full. Core to the company's strategy has been keeping an eye out for exceptional new business opportunities which could complement the existing asset base with strong investment returns and ideally an ability to enhance our distribution strategy. This acquisition meets all of these criteria, providing a relatively unique opportunity for the company to acquire a material non-operated position in a low-risk producing domestic gas asset with a funding structure that allows the group's distribution strategy to be continued and potentially enhanced. The initial purchase price of approximately 27.6 million US dollars, or 42.5 million Australian dollars, is to be fully funded from debt which is secured against the Mereenie asset only, with deferred and contingent milestone payments of up to 5.8 million US dollars, or 9 million Australian dollars, to be funded from cash flow over the next 24 months. The acquisition price, inclusive of the contingent payments, represents a cost of approximately $5.30 US a barrel of oil equivalent on a 2P basis, with a substantial portion of the forecast gas production over the next 5 years already contracted at attractive gas prices. The acquisition has a number of strategic benefits, providing a low-risk and readily fundable entry into the Australian domestic gas market, which is forecast to have robust demand. With an acquisition effective date some months ago of 1 April 2023, the acquisition is expected to be cash accretive, with a 2P reserves forecast to generate over a 20% internal rate of return for Horizon at relatively modest gas prices. As I mentioned, the acquisition consideration is substantially debt funded, allowing our distribution strategy to continue. It will diversify and grow Horizon's production base by adding a third asset, and diversify the product mix with the addition of gas, a key fuel for the energy transition. The Mereenie asset itself has several significant infrastructure-led opportunities, which provide some running room and upside potential in the asset, which I will touch on later. On the left of the slide is a map showing Mereenie's location, situated approximately 250 kilometres to the west of Alice Springs in Northern Territory, with connection to the gas market via the Amadeus pipeline. Some additional key highlights and metrics are as follows. Mereenie is a conventional producing onshore gas asset, which will initially add approximately 1,150 barrels of oil equivalent per day net to Horizon, made up of approximately 7.5 TJs per day of gas and around 60 barrels of oil per day of light oil. The production license for Mereenie was recently extended to 2044, with modelling suggesting the field remains economic beyond this until around 2048. Accordingly, this acquisition builds a foundation for Horizon production well beyond the existing asset base. The Mereenie field is strategically located in the Northern Territory, with access to both the Northern Territory and East Coast gas markets, both of which are forecast to have robust demand and relatively tight supply. The recent offtake agreement signed with Arafura Rare Earths Limited in support of their new rare earth mine, which will provide minerals critical to the energy transition, demonstrates Mereenie's importance and strategic value. Arafura is one of a number of high-quality contract counterparties whom have contracted offtake with the Mereenie joint venture for the supply of gas over the next 5 years or so. This contracted offtake underpins both the purchase price for the asset and supported Macquarie's ability to substantially debt fund the acquisition with a new 5-year debt facility. Longer-term offtake is uncontracted, providing significant opportunity to take advantage of improving market conditions. The acquisition will increase Aurizon's 2P reserves at 30 June 2023 by 129%, with the addition of 6.3 million barrels of oil equivalent, made up of 34.1 PJs of gas and 0.4 million barrels of oil. Importantly, the acquisition fits the strategy, with Aurizon's production base grown and diversified, whilst allowing for continued distributions. Now, for those not familiar with the Mereenie asset, it is a really extensive oil and gas field that was discovered back in the 1960s and brought onto production in 1984. The field is a 4-way dip anticline that has a length of approximately 40 kilometres and width of more than 5 kilometres, so it's very large at around 200 square kilometres. The field has 2 main reservoirs, the Pacoota Formation, which has been the development focus, and the shallower Stairway, which, whilst having some existing production, remains largely undeveloped and provides a substantial upside opportunity. The field was initially largely developed with a focus on the oil rim, with oil piped back to a diesel topping plant at Alice Springs, with much of the gas re-injected back into the field. Full gas blowdown only commenced relatively recently, with the opening of the Northern Gas Pipeline in 2019, linking the Northern Territory with the East Coast gas market at Mount Isa, allowing for the full gas productive capacity of Mereenie to be exploited. Gas from the field is sold to regional miners in the Northern Territory, such as the McArthur River Mine, but also the government utility Power Water Company. Gas is also sold into the East Coast gas market with offtake agreements with South32 and Shell. The recent signing of the Arafura Rare Earths offtake agreement is a substantial milestone, as the mine's location is only around 250 kilometres northeast of Mereenie, located in very close proximity to the Amadeus gas pipeline. Accordingly, it offers a unique strategic offtaker, ideally located, and with its rare earths critical to the energy transition, it demonstrates the critical role of Mereenie gas. Arafura's rare earths are destined to be used in electric motors and batteries for use in wind turbines and electric vehicles. Besides the gas, oil and condensate are produced from the field, processed on site, and then trucked to Port Bonython for storage prior to export by tanker, primarily to refineries in Singapore. As mentioned, while the field's initial development focus was the oil rim, much of the recent efforts by the joint venture have been on optimising gas production. Most of the production wells are concentrated around the oil rim, with very few production wells at the crest of the structure, so gas infill drilling programs are focused on crestal wells. The first of these programs is being matured at present, with a view to potentially drilling 2 infill wells next year to boost gas production. Another focus of the joint venture is on the Stairway Formation, with further appraisal and development being evaluated. More recently, the joint venture has also partnered with Twin Bridges to evaluate the potential for helium recovery from the raw gas stream. With the closure of Australia's last helium production plant in Darwin earlier this year, helium is becoming increasingly rare and valuable, and so this initiative could provide an additional substantial revenue stream. Whilst the Mereenie field has been in operation for many years, the joint venture has overseen a significant period of operational improvements and developments over the past 5 years, primarily focused around the Northern Territory connection to the East Coast gas market, which has substantially reset gas prices. A number of the key initiatives and investments are detailed on this slide, including a central processing facility upgrade in 2018, the Northern Gas Pipeline connection in 2019, infill drilling and recompletion programs in 2021 and 2023, a flare gas reduction project which is currently in progress and will have the dual benefit of increasing sales gas and also reducing field emissions by around 30%. As I mentioned, the joint venture is also exploring helium recovery and maturing a 2-well infill drilling program. So it has clearly been a very busy period for the joint venture, and many opportunities remain in the pipeline. Now, to help illustrate the impact of Mereenie on the group's production portfolio, We've included a series of charts which build upon the Maari and Block 2212 production charts we have shared in previous presentations. On this first chart, we have the base 2P production forecast for our existing assets, Maari and Block 2212. We then add the Mereenie 2P reserves forecast, which as you can see provides relatively stable long-term production, roughly equivalent to Maari's daily production on a BOE basis. Importantly, Mereenie's production has the potential to continue out until the late 2040s, so provides the foundation for production from the group to continue well beyond the existing asset base. This clearly has many benefits. It provides a strong platform to allow for the continuation of distributions beyond the life of our existing assets. It provides an additional cash flow stream to help support funding for Maari's ultimate decommissioning, potentially even reducing the amount of funds that we'll need to set aside over the coming years. And it provides a domestic revenue stream, which establishes a pathway to potentially franking of dividends in the future. Now where it gets really interesting is when I add to both Maari and Block 2212 some select indicative future activities. Now I stress that these are indicative only, but as previously mentioned, bringing into production our substantial contingent resources is a priority of the company. Firstly, I will add the indicative Maari life extension out to the end of 2030, for which an application is currently being progressed. Now I will overlay the Block 2212 indicative future activities, which we've included in earlier presentations. Now I stress that these are indicative. However, you will see that with the addition of Mereenie, and subject to us being able to unlock the remaining potential in Block 2212, we have the potential to average production rates over the next 3 to 4 years at around 5,000 barrels of oil equivalent per day net to Horizon, similar to the record production achieved in FY 2023. Importantly, we've already commenced maturing a number of incremental infill well opportunities in Block 2212, with a drilling program being scheduled for 2024, subject to joint venture and regulatory approvals. I should also note that the Mereenie production forecast included also excludes any potential production from Mereenie indicative future activities, such as the stairway, which could be quite substantial. To highlight the running room in the asset, this slide shows the various upside opportunities being actively evaluated. Firstly, there are Crestal infill gas wells, which look to target undrained hydrocarbons at the crest of the structure, with 2 wells being considered for 2024. Then there is the Stairway Formation, which sits above the main producing Pacoota reservoirs. Importantly, there are already many existing well penetrations through the Stairway, and some wells in the field already produced from the Stairway, with approximately 2.9 petajoules of gas on a gross basis produced to date. As you can see in the slide, the Stairway volumetrics are substantial, with 2C contingent resources of 91 petajoules of gas on a gross basis, approximately 23 PJs of gas net for a 25% working interest, with significant oil potential also. The deeper Pacoota 4 reservoir also has substantial gas and oil potential, as do various other tighter gas and shale intervals in the formation. As already mentioned, other potential revenue streams are being evaluated, with helium recovery from the raw gas stream an immediate focus. Importantly, the infrastructure is already in place to make any future developments of these opportunities more commercially viable. Some may ask why diversify into gas when in recent years the company has focused on oil production. As a reminder, this is not Horizon's first foray into gas, as we operated and participated in gas exploration and appraisal for many years in Papua New Guinea. So we have the requisite in-house technical skill set to play an active role in the Mereenie joint venture. Now, whilst Australian domestic gas went through a bit of a challenging period 12 months ago, with government interventions such as price caps and the mandatory code of conduct, it is clear the government realised it overreached in many of these policies, particularly for the smaller domestic producers. Importantly, the Mereenie field is exempt from many of these policies and also has emissions below the safeguard mechanism, which will be further reduced once the flare gas recovery project is completed. As for the general domestic gas market, there is increasing government recognition of the important role gas will play in the energy transition. Not only will it be used for firming power when wind and solar are unavailable, but also for critical mining operations in order to extract and process the necessary minerals for the transition. This couldn't be exemplified better than in the recent signing by the Mereenie joint venture of the gas sales agreement with Arafura Rare Earths Limited, which, as I mentioned, will extract and process rare earths for use in wind turbines and electric vehicles, amongst other things. There is also the much publicised critical shortage of domestic gas, which we expect will continue to make gas prices robust, with Mereenie having the dual benefit of being able to sell into both the Northern Territory and the East Coast gas markets. We also have a view that with increasing regulatory and activist pressures, that existing production assets are substantially more valuable than fields requiring development. As I noted, the Mereenie joint venture has recently already secured a licence extension to 2044, a clear demonstration of the critical importance that the Northern Territory government see in the field. So in summary, Horizon is to acquire a material, non-operated asset in a low-risk strategic domestic onshore gas asset with a funding structure which allows the company to continue its distribution strategy. The acquisition has strong investment metrics and will more than double Horizon's 2P reserves and provide a production base beyond the life of our existing assets. The acquisition will diversify and grow the production base with the addition of gas, which is widely recognised as key to the energy transition. The Mereenie asset has significant infrastructure-led opportunities which provide further running room, and our objective is to work with the joint venture to unlock this remaining value. The transaction, of course, remains subject to finalisation of debt facility documentation and customary conditions, including regulatory approval such as approval by the Foreign Investment Review Board, joint venture and landowner consents. We anticipate completion during the first half of calendar year 2024. Many thanks for your attention to this morning, and I look forward to providing further updates on the transaction over the coming months ahead. Thank you.